Have you ever wondered how people are able to buy rundown houses, fix them up, and sell them for huge profits? Well, most people don't do this with cash. They use what's called fix and flip loans. Well, today I'm going to show you the exact steps to get a fix and flip loan, how to qualify, and how to make it work for you, even if you're just getting started. Hi, I'm Justin Brown, real estate investor, mortgage pro, and I've been doing this a very long time. So here's exactly what you need to know. All right, so let's start with the basics. A fix and flip loan is basically a short-term loan that you could use to finance the purchase and all the renovations of a property that you intend to fix up and possibly flip or even keep as a rental. It's basically meant to borrow money specifically to go in and renovate a property. I'm going to break down each step from you, from finding the right loan to then either selling the house or refinancing out of it once all the work is done. So let's get to it. These loans are a lot different from regular loans because they're short term, typically from 12 to 18 months. The goal is to buy a house, fix it up fast, and then either put it on the market to sell it for a profit or refinance into a permanent loan to pay that money off and then rent it out. That's actually called a BRRRR: buy, renovate, rent, refinance, and repeat. The house that you're buying is actually the collateral for the bank. So if you don't pay that loan off or you default on it, they will take that property back. But don't worry, if you stick to the right plan, you know your numbers, and you do this right, that's not something you're going to ever have to deal with. So again, it's a short-term loan, 12 to 18 months, that's designed to either buy, fix, and sell, or buy, fix, and refi. And then two, the collateral is the house. So if you can't pay it or you default, the bank's going to take that home back. So make sure you have a really good idea of the time it's going to take you to do this, and you don't bite off more than you could chew. Don't take on too big of a project if you're just getting started. So then we got step two, which is finding the right loan and qualifying for it. And not just anyone's going to be able to get a fix and flip loan. So here's what you're going to need to do to qualify. So one, they're going to focus on your credit scores. They're going to want to make sure that you have decent credit and then you have a track record of paying your loans back on time. The higher your scores, the easier it'll be. Two, you're basically going to need a clear plan, basically a business plan that's going to show all the costs to buy, fix, and sell the property. This includes a scope of work, which is an estimate of how much work is needed and all the detailed breakdowns of what each piece of the project is going to cost you. You could typically get this from any contractor, and you're going to want that regardless for your own security and certainty on knowing your numbers. Three, experience is actually not required to get this type of loan, but it is helpful. But if you are new or you don't have experience, that detailed plan is going to be even more important to have. Some lenders prefer only working with experienced investors, but not all. And the ones that don't, you're absolutely going to need that detailed plan. So to recap, make sure you're checking your credit scores and working on improving them if necessary. Maybe start by paying off some small debts to give it a quick boost, or maybe work on finding somebody to co-sign or be a partner on the project that has really good credit, which will help. And then again, making sure you have that detailed business plan. There's plenty of templates online, but at the end of the day, you want to make sure whatever that plan is that you use or template that you use, it includes a clear picture of all the costs that it's going to take to purchase the property, renovate the property, and then the resale value of what that property is going to be. Next, you're going to want to have a really clear understanding of the loan ratios that the lenders look at. At the end of the day, lenders are going to decide on how much money they're going to be able to loan you based on these three key ratios. So here's the breakdown. One, you got the loan to value ratio, or the LTV. This is basically how much is that property costing to purchase it right now and how much money are you putting down. That's the loan to value. So on a $100,000 home, if you could put $20,000 down, that puts you at an 80% loan to value. You're putting 20% down and you're financing 80%. So if a lender tells you they have a max loan to value, that means that's the minimum down payment you're going to have to pay. Next is loan to cost. This basically means how much is the total cost of the project and how much do you need to finance for not only the purchase, but all the renovations, the loan to cost. So if that $100,000 home you're buying also needs $50,000 in work and the lender says they have a maximum 70% loan to cost ratio, that means the max total financing that they'd be able to offer you on that $150,000 project is $105,000, which is 70% of the loan to cost. And then last, you have the after repair value, the ARV. This is basically what that home is going to be worth once it's all said and done. So if a lender says they finance up to maximum 60% of the ARV and that house is going to be worth about $300,000 once it's all done, then they might be willing to lend you up to $180,000 for that project. So what you want to do when you are talking to lenders is you want to find out what is their max loan to value that they'll lend on, what's the max loan to cost that they'll lend on, and then what's the maximum ARV that they'll lend on. Those are the three key figures that you need to know to see how much financing you could get. The maximum LTV is going to be based on the minimum amount of down payment you need to put on the purchase. The maximum loan to cost is going to determine how much they'll lend you for the renovations. And then the maximum ARV is going to limit how much total financing they're going to allow on it based on the future value potential of that property. There's plenty of online calculators that'll help you crunch all these numbers as well, so you know them, because knowing them is going to be very important when you're talking to lenders to see what's possible for you. So there's definitely different types of loans loans you could use to fix and flip a property. So let's go ahead and cover the main ones and what they're best for. So one, you got hard money loans. These are basically private lenders that really don't care as much about credit scores. They care more about the project, and they're able to fund loans fast, but they come with much higher interest rates and closing costs. Two, home equity line of credit. If you already own a home, you could potentially get a home equity line of credit if you have good credit scores, and then you could either use that equity line to fund the whole project for yourself, or you could actually use that home equity line just to cover the down payment and closing costs if needed. So you could couple a hard money loan and a home equity line of credit to fund the whole project as well. Most lenders will allow you to use your equity line to cover the down payment and closing costs. But just be careful, because if you can't repay that loan, the hard money lender will not only foreclose on that property you're trying to flip, but then you might be in trouble on your own home if you can't repay that HELOC. And then last, there's a business line of credit. This might be a great option for experienced investors. It's basically a line of credit that you could use to buy and fix properties as you need it, and then you're only paying interest on what you use. But again, you're typically going to need a lot of experience for this and good credit. So with all this, if you already own a home and you have enough equity, I would use that home equity line of credit to fund the whole project, because it's going to be cheaper. But if you don't already own a home, or you don't have enough equity in your home, then the next best thing is going to be to start with a hard money loan. And again, if you do have some equity, you could use that to cover the down payment and closing costs for that hard money loan, potentially making it so you don't have to come out of pocket for any of the project. So once you find a property, you run your numbers, and it looks like a deal that you want to jump on, the next step is to start applying for the loan. And here's the key documents you're going to want to have ready when you start that application. So one, you're going to want to be able to show a clear picture of what that home's going to be worth, what the ARV is going to be. So you're going to want to know your comps. You need to be able to pull listings in the area that are less than a mile and are similar to what your home's going to look like, so you can determine what the value will be on that property. And if you're new to this and want some help learning how to comp properties or determine a home's value, then I'll drop a link here that has a video where I explain all that and break it down for you. Next, you're going to want to have that scope of work from a contractor that shows the total breakdown of costs of what it's going to take to renovate this property. And it should have everything broken down: how many new windows, how much it's going to cost, how much for the flooring, what type of flooring, the paint, the roof, everything that's going to be needed, and a clear breakdown of the cost. And then next, you're going to want to use a fix and flip calculator to have all those numbers broken down. That shows how much money you need to borrow, how much your renovation costs are going to be, how much your interest and holding costs are going to be, how much your closing costs are going to be from the purchase, how much your potential closing costs are going to be on the sale, so that not only the lender, but you have a very clear picture of the bottom line to see how risky or how much potential this project has. And then lastly, if you have done other projects or flips in the past, then you want to definitely make sure you include that information as well, so that they can see your experience. And that's it. You now have a step-by-step plan to use a fix and flip loan to fund your next project. Remember, it's all about planning, budgeting, and staying on top of the timeline. So if you are ready to take on your first flip, make sure to follow all these steps and hit that like and subscribe button for more tips to make real estate real for you.